We have Pramod Gubbi with us right here in the studio. So let's get a perspective from him as well with all the geopolitical news. Pramod, it's thrown things a little up in the air very early on in the year. What are you making of these developments?
Well, I think it's hard to predict these things. We are no geopolitical experts. We have no particular view on how this is going to transpire. But as investors, I think we need to construct scenarios and figure out how it affects our portfolios and our investment decisions. I think the clear ramifications if the tension escalates is clearly going to be through the oil price route. And through that, we have issues on the fiscal deficit and inflation and everything else. So the macro bit clearly is negative if this thing escalates. It'll also create some sort of risk aversion in the markets. So that means global capital flows into India will also be affected. So in more ways than one, it's a clear negative on the macro front. But as investors, I think we look at our portfolios, our companies. Will these changes affect the fundamentals of our companies is what we need to ask ourselves. And I guess it's, again, a timely reminder for us to look at focus on companies which are fundamentally strong, which have pricing power, even if oil is an input or a input commodity into those companies. If you have a competitive position strong enough to pass on prices on to consumers, you're relatively less hit. I'm not saying you're totally immune, but that again is a timely reminder for all of us to focus on strong companies with good competitive advantages, strong balance sheets which can weather through these storms, because these are pretty much a given these days in terms of stock markets. You can't be prepared for sort of a Goldilocks scenario all the time. Anything can happen from anywhere. So all the more reason, as investors, we need to focus on fundamentally strong companies which can weather through any sort of macro issues that can crop up from anywhere.
And I guess the litmus test is very soon. Later this week, you've got Infi reporting its numbers, though TCS has been delayed. But let's talk about automobiles first. Would you say that the volume decay has now been arrested, and can we finally see some green shoots, or the monthly data still indicates that the pressure on the earnings is going to be pretty stark this quarter too?
Well, I think the monthly data has been volatile, and I don't think we can conclude one way or the other based on a few data points. You'll need to see a sustained improvement in those numbers, which we haven't, to be honest, and hence I don't think we can call the bottom very early. And it's difficult to pinpoint these bottoms in any case. So I would rather take a longer term view. At some stage over the next quarter or two, you will see the bottom. You will see some sort of recovery. If you have an horizon of 3 years or longer, I think autos is something that you should start looking at. You have to remember that it's impossible to time it perfectly. But to the extent that valuations are reasonably below intrinsic values, you can look at building positions there. Whether this is the quarter where it turns around or not, it's not going to make much of a difference in a longer term view.
Okay, when it comes to cap goods, would you say that the commentary on order booking would continue to be bleak, because we haven't really seen, even after the tax cuts coming in, any major large infrastructure activity? If anything, everything is at a standstill.
Absolutely. No, I tend to agree. I think it's too early. You've barely had a quarter. I think even the companies which plan to capitalize on these tax cuts and start some capex activities will take time to go back to the drawing board and see how they can revisit in terms of new investment activities. So I would reckon it's too early to look forward to, in this quarter's earnings commentary, to see any sort of pickup in investment activity. We've already heard some of the management teams that we've met over the last few quarters. There's absolutely no signs of pickup in capex activity. But having said that, I think at some stage there are well-run companies which are already looking at increasing their reinvestment plans. Clearly, the government has given a sort of a gift in the form of those excess cash flows which are retained with them, which they can choose to deploy. Some of these companies in sectors which have secular growth are clearly looking to deploy them. Whether it's, again, this quarter or next quarter, it's anybody's guess, but at some stage you will see a pickup in investments.
Again, when it comes to auto, the tax cut, of course, you spoke of that, but away from auto and a view on the banks rather, let's get in a sense as to how you're looking at some of the non-banking lenders as well as the marquee private sector banking names in light of the bad loan growth as well that we've seen.
Well, I think in lending in general, you will see a massive consolidation going forward. We've already seen, right? So we've already seen that the NBFC sector as a whole is shrinking, but yet there are guys like Bajaj Finance who are growing at 35%, which is a massive consolidation or increase in market share. And that, I reckon, is going to stay. The whole market will consolidate into a few hands which have had demonstrable track record in terms of growing the loan books with very reasonable NPAs, a very strong asset quality. And the wholesale market will continue to provide capital to these guys. And capital is an input for lenders, and they will continue to use that position to consolidate. The same thing with the banking industry as well. I think deposits has historically resided with the public sector banks, but I think we're gradually seeing private sector banks eat into the market share of public sector banks on the deposit side as well, which will only strengthen their ability to take market share on the asset side. So both ways, a handful of private sector banks and a handful of NBFCs will consolidate market share. And if you pick the right one, irrespective of the macro, irrespective of whether credit growth picks up in the system, these companies can continue to demonstrate loan growth simply by taking market share from those which are left behind.
Sure. What about consumers? You think the persistent volume worries and the dip that one has seen, and that too coming in on the back of a large base, the sector being the biggest outperformer of the last 10 years, do you think it could continue to play spoil sport, or again, could we see any strategic moves here and there? You know, maybe some of the rural focused companies manage to beat the storm?
Well, I think generally, country as a whole is seeing a slowdown. I don't think even the stronger franchises within consumer will escape that. They will also see some sort of a slowdown in terms of volume growth. But having said that, what you need to watch out for is there any deterioration in the competitive position? Are some of the better run franchises still growing faster than the rest of the industry? And that's what you need to look for, because I guess at some stage the reversion to mean should happen. If we're talking about a pickup in investment cycle, at some stage investment cycle will result in job creation. Job creation would result in income generation, and that'll increase disposable incomes, and that'll ultimately benefit the consumer companies. So consumption growth will pick up eventually. All you need to focus on, are you positioned in the best franchises, which are continuing to grow faster than the industry, even through this slowdown. And as the pickup happens, as the recovery happens, these ones will be the first to recover and the fastest to recover.
What about defensives by way of earnings in terms of IT and pharma?
I think given where the currency is headed, IT and pharma clearly come up on most people's radars. I think if the geopolitical situation escalates, you can see 75 on the rupee fairly quickly. And I think you do need some exposure on IT and pharma if you are to be capitalizing on the rupee depreciation.
But would that be a near-term trade because of the escalations and the geopolitical tensions, the knee-jerk reaction that you're seeing in the dollar-rupee parity?
Well, eventually we do have to, given the state of our exports franchise and the exports competitiveness, the rupee depreciation is a given. The geopolitical crisis could just be a catalyst which accelerates that depreciation. Now, whether the IT and pharma stocks will react to that immediately, I think the markets are forward-looking anyways. Even before the earnings start to reflect the weaker rupee, you will see the stock prices reacting much faster than that.
And just before we let you go, expectations from the budget.
Well, I think we've had a reasonable set of announcements since August, September from this government towards improving the taxation infrastructure in the country. I think you should expect some more refinements on the direct tax front, particularly in the personal tax front, which should be a positive booster for the economy. Other than that, I think the bigger thing to watch out for will be the fiscal deficit, given that on the revenues front, the slowdown in the economy is clearly not helping the taxation. But at the same time, there is a need to stimulate the economy through further expenditure on the behalf of the government. How does the government balance the twin requirements is what the budget is all about anyways. And this year, it'll be that much more important. I think the market will be a bit forgiving if you see a little bit of slip up on the fiscal deficit. As far as the revenue collection and the expenses number are credible, I think that's something that the market will watch out for.
Okay, great to have you in the studios. Thank you so much for taking the time out and speaking with us today.